Investing. When most people think of it, they imagine day trading, stock tickers, and people screaming at each other. But apart from what you may have heard, investing doesn't need to be to get them down. You could make millions of dollars in your lifetime. With the help of my friend and personal finance expert, Ramit Sethi, we're gonna ditch the generalities and get into the specifics, covering how to start investing, what accounts you should open up, and all the things that you should and shouldn't be doing when it comes to investing.
This is a critical mistake people make, and it will cost you hundreds of thousands of dollars.
This video is sponsored by Squarespace. More on them later. My early 20s weren't exactly my most productive financial years. I remember counting pennies in line at Wendy's to get their $1 chicken sandwich. And if you're in a similar situation, it might feel impossible to even start thinking about investing. And that's because you probably shouldn't. Before you open up your first investment account, there are two big steps that you need to take that most personal finance experts can agree on. First, you need to build up an emergency fund. You can start with a month of savings, but eventually you should get it up to 3 to 6 months of basic expenses. We're talking about the bare minimum: rent, utilities, groceries, and gas. What is the absolute minimum that you need to get by on? And second, you should pay off all of your debt except for your house. You specifically want to focus on the debt with the highest interest rates. So those credit cards, student loans, and car loans that are 8, 9, 10% or more should be tackled as soon as you've got your emergency fund filled. The power of taking these two steps alone are huge when it comes to your personal finance journey, and they will likely take years of saving, patience, frustration, and sacrifice, especially if you graduated with $100,000 of student debt like I did. But once you pay off your last loan, you'll finally be ready to start investing in the stock market. Warren Buffett once famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Compound interest is the reason you need to start investing as soon as you possibly can.
What we know is that over the course of a long period of time, I'm talking 40, 50, 60 years, the market tends to return about 7 to 8%. That's per year. So people go, well, is that a lot? Is that a little? It doesn't mean anything to people. What that means is that your money will essentially double every 10 years if you do nothing.
Let's say you invest $5,000 a year from age 25 to 65. At an annual return of 8%, you'll have a total of nearly $1.3 million. If you chose not to invest and instead stashed the money away in your sock drawer, you would have $200,000. That's a difference that will easily change your life. So the minute that I paid off my last student loan, I knew that I wanted to start investing, but I still had so many questions. How do I open an account? What company do I use? How much should I invest? What stocks do I invest in? It was truly overwhelming. There are a number of different accounts that you could open up with varying fees and tax advantages. My guess is if you've thought about investing before but haven't taken the leap, this is where you've gotten stuck in the weeds. So let's break down exactly what you should be doing from the minute that you decide to start investing. In the US, if your employer has a 401k plan and offers matching contributions, then this is the first account that you should start investing in. And you should probably take advantage of this deal even before you finish paying off all of your debt. Put as much money into this 401k plan as your employer will match. After that, the first account you should open up is a Roth IRA. If you meet the income requirements, there are some great tax advantages to Roth IRAs, and it's why most personal finance experts recommend it. But what company should you trust with your money?
There are a few companies I love. I personally use Vanguard. I have no financial affiliation with them, but that's where I suggested my wife open her account. They're super low cost. They don't get you with a bunch of fees. That's important. Fidelity is also very good. Schwab is also very good. All three of these are great. Some people ask about robo-advisors. It's really popular. I think they're fine. If you are coming to me, you're saying, Ramit, should I do Wealthfront or Betterment or Vanguard? There is a slight difference in fees. You know, you might be paying about 0.3% more for Wealthfront or Betterment. In the grand scheme, it's not the worst thing you could do. Personally, for me, I don't think it's worth it. I don't mind that Vanguard has a worse interface because I hardly log in. It's not important to me. And I want a company that is focused on low fees.
So to keep things simple, if you haven't opened an account already, just go with Vanguard. They've got really low fees, give you all the investing options you need, and they make it really easy to get started. Okay, now that you've created an account, what do you do next? Well, you actually need to invest your money. And regardless of what your brother-in-law told you, investing your life savings into Bitcoin is probably a terrible option. I think when a lot of people think about investing in the stock market, they think about, like you said, Tesla. They think about investing in specific companies.
Some of them go, Ramit, why would I invest in the stock market? 7%? That's for losers. Bitcoin, you can average 50 to 60% a year. I go, all right, let's start with some basic math here, which you missed the day they taught that. If you're getting 60% returns per year, pretty soon you have more money than all the money in the universe. And there are essentially no investments that are consistently getting you 60% returns. Oftentimes, really what people are doing with these highly speculative investments is they are admitting, I have lost the game of money for myself, and the only chance I believe I have to win is to buy a lottery ticket. And that is not how you invest. That's not how you do it.
So instead of investing your money into one company, one stock, or one risky bet, you need to diversify by investing in something called an index fund. An index fund is a type of investment that pulls together stocks, bonds, and other securities into one diversified portfolio. While there is always a risk when it comes to investing, this reduces the overall amount of risk that you need to take. What are the investments that are safe in the long run, but that will also give us a return where we can actually have a living when we retire?
I love a target date retirement fund. You simply pick the year that you're going to retire, basically the year you're going to be 65, and you just put all your money into it. It's automatically diversified, automatically. It includes stocks, bonds, it includes domestic, large caps, all that. And you just put as much as you can. They charge essentially no fees. This is not a financial advisor that's charging you 1%. It's just a computer that's doing it for you. It's almost, people almost find it unbelievable. They go, Ramit, you're telling me that I just pick one target date fund and I invest in that same fund in my 401k, in my Roth IRA, even in a taxable brokerage account? For the most part, yes. For the vast majority of people, a target date fund is a fantastic thing. If I had, if I were telling a brother or sister, family member, and they're 25 years old, what should I do? I'd be like, put every extra dollar you've got in a target date fund and get on with your life.
I want to share the exact index fund that I invest in, as well as the strategy you need to know once you start investing your money into the stock market. But first, a quick word from my sponsor, Squarespace. So I chose to build my first website on Squarespace 8 years ago for 3 main reasons. Their templates are beautiful, it's really simple to make changes, and you don't need to know any code. Let me show you exactly how easy it is. Let's say you want to create a blog documenting your journey out of debt and towards financial freedom. You get started by going to squarespace.com and buying your first domain name, something like mattonthemoney.com. Next up, you grab a template that matches your vision. This one's perfect. And then the fun part, you start creating by simply dragging and dropping your content. Set your brand colors, add your logo, and take that terrifying step of writing